After the collapse in global bond yields since 2020, financial markets are experiencing something new. And because of trade tensions and an increase in inflation, investors are drifting towards negative bond yields because of their great returns and money-making potential. What's a negative bond? But before we go into the details of why investors love negative yield bonds so much, you need to know what a negative yield bond is and how it works. To put it simply, a negative yield bond is when an investor receives less money when their bonds mature. This means that they receive less than the original price they paid for the bond when they bought it. It's an unusual situation where the people who deposit or buy bonds are paying the bond issuer a net amount when the bonds mature, instead of earning a larger return through interest. You're probably aware of how bonds work. They're basically instruments of debt created by governments that aim to raise money. This money is then invested by the corporations or the government in projects to create more money. Investors purchase the bonds at a principal amount and get an interest rate in return. This is also called a coupon rate and is the money used for holding the bond. As you might already know, each bond that you purchase has a maturity date when you get paid back the principal amount that you initially invested. But bonds that have been sold by investors before they've matured trade on a secondary market, which is known as the bond market. Bonds in the bond market can be priced differently and are not necessarily sold at their face value. So, supply and demand conditions and economic volatility can affect how bonds are priced in this market. So, if an investor buys a bond from a corporation for $90 and receives a promise of $100 face value at maturity, the investor could sell their bond at the bond market for a higher price depending on the bond's coupon rate. Reasons why investors buy negative yield bonds. Did you know that there are now more than $16 trillion negative yielding bonds that make up 29% of all global investment grade fixed income assets? These are numbers from 2019 and have increased since then. Large corporations like Nestle have issued their first ever negative yielding corporate bond that works for a period of 10 years. Even though these kind of bonds go against the conventional financial theory, negative yields are probably going to be a part of the world economy for quite some time. Sweden was the first country to put negative yields to trial in 2009. And since the time they first trialed negative policy rates, many countries around the world have broken the zero lower bound. This has been done to improve economies and fight against their currency strengthening. If you're not aware of what currency strengthening does to an economy, it basically adds strain to a country's economy and harms exports by making them more expensive for the country. This results in the country spending more money exporting goods and services from other countries or trying to cut back on exports and save money, both of which are harmful for the country. Even in countries like the US, the possibility of negative yields is now considered by economists and policymakers. Even the former Federal Reserve Chairman Alan Greenspan stated that there is no barrier stopping negative yields in the United States. To an investor, this might seem a little crazy, and it makes sense because who wants to pay for lending money? But if you're looking to invest in negative yield bonds, you'll be happy to know that these might not be as crazy as they sound. Investors that are interested in buying negative yield bonds usually include insurance companies, pension funds, and even central banks. There are retail investors who like purchasing negative yield bonds too. One of the main reasons why these corporations like buying NYBs is because many hedge funds that manage mutual funds are required to meet requirements that include asset allocation. If you don't know what that is, asset allocation means that the investments included in the fund must have a part allocated to bonds so that a diverse portfolio can be created. If a portion of the portfolio is allocated to bonds, the risk of loss decreases. This is because the risk of loss from other investments is reduced. Also, bonds are often used to pledge as collateral before loans are taken out or financing happens. So they need to be held regardless of their yield. Another reason why investors are drawn towards NYBs is because of deflation risk. Some investors think that they can make money through negative yields too. And even though it might seem senseless to make money by selling bonds for less than the original price, there are foreign investors who wait for opportunities to earn from NYBs. They believe that the bonds will eventually shoot in price after the currency's exchange rate rises. This would ultimately offset the negative bond yield and give the bond owner a profit. To put it simply, a foreign investor would compare and then convert their investment into another country's currency when they're buying a bond. But when they decide to sell the bond, they can convert the currency back to their own local currency. This way, they'll be able to earn a profit from the currency exchange fluctuation that happens these days. They might even face a period of deflation domestically, which would lower prices in their country's economy and allow them to make more money using their savings to buy more goods. Investors who don't partake in currency hedging are definitely going to lose money if they hold their negative yielding bonds to maturity. This is why a lot of them don't do this. Instead, many of them believe that yields will fall further, buy NYBs, and then sell them to get the profit that they originally wanted. An example of this is a Swiss bond that has a lifespan of 10 years. This bond was yielding negative 0.1% at the beginning of this year, but by the end of August, it had already returned 5.6%. Negative yields don't necessarily act as an impediment to positive returns. Any rise or fall in yields could lead to a loss for investors. Another reason why investors like to put their money in NYBs is because of the benefits that come with the portfolio diversification. If you have a broader asset allocation, your bonds will still play a crucial role, even if they're negative yields. An example is the 3-year rolling correlation between German bonds and the German DAX stock market index. According to statistics, the European Central Bank's quantitative easing program led to higher bond prices, which meant lower bond yields. It also led to higher stock prices in the time between 2014 and 2017. Other than this time, there has been a strong negative correlation between both German bonds and the German DAX stock market index. This means that bonds usually perform better when equities are struggling. And for investors who want a diverse portfolio, NYBs make for a great option. Did you know that investors who base their investments on liability don't really care much for the level of yields? These liability-relative investors include insurance companies and pension funds and are not always concerned about the amount of money they'll be receiving when the bonds mature. In fact, they often end up buying bonds that act as a match for their liabilities. If you're wondering how they calculate these liabilities or what they base them off on, the present value of these liabilities is calculated in a variety of ways. But the most common way is to base them off government bond yields. Investors who like to invest in negative yielding bonds usually see bonds as a deflation hedge. Bonds, like most asset classes, do struggle in a period of deflation. This is when their prices fall, and these falls can sometimes be drastic too. But fixed-interest government bonds act as an exception. This is because they have fixed coupon and principal payments. And as a result of this, they retain their original value and are sure to deliver a positive return. This will happen even if inflation falls below their yield. So, to put it simply, a negative-yielding bond can deliver a positive return if the economy is suffering from deflation. This is why investors feel that negative-yielding bonds have the ability to hedge against deflation. And even though deflation isn't a problem for Europe at the moment, nobody knows what the future holds. Even countries like Japan have been struggling with deflation for years. So, what can you do if you're an investor in the secondary bond market looking for NYBs to invest in? The answer to that varies according to your skill set, expertise, the kind of bonds you're looking for, and the amount of money you're willing to invest. It also depends on other things, like the amount of experience you have with bonds, and if you've worked with them before. Usually, large companies that can afford to take in a little loss invest their money in negative-yielding bonds. But if you have the capacity to get some for yourself and earn a little bit of profit through currency conversions, you can do your research and take the risk. And with that, we'll end this video. Thanks for watching.